Hello, my name is Drew James and I will explain about Situation 1. Situation 1 is about Lexus company loan application to N&N Bank, which requires me as financial manager to evaluate financial performance by comparing with industry. This situation is related to topic 2 that we have studied, which is the topic of the financial analysis. So, to compare financial performance with the industry, I use financial ratios such as liquidity, activity, leverage, and profitability ratios. First, I calculate the liquidity ratios, which are current ratio and acid test ratio. I found that the liquidity ratios of Lexus company is poor than the industry. This shows that the company is unable to meet its current obligation as they come due. Then I compared the leverage ratios. This time I found that Lexus company is effective in financing decision and the use of debt financing by the firm. This is because the percentage for debt ratios is lower and time interest earned is higher for Lexus company. For activities ratios performance is as good as leverage ratios. With lower average collection period and better inventory turnover, I found that Lexus company is efficient in utilizing its inventory to generate more sales. Lastly is the profitability ratios that will show how much the firm profits in overall business operation. The lower net profit margin and the return on assets compared to the industry indicate that the Lexus company is not able to generate profits well. So, that is all I can explain about the comparison of financial performance for Lexus company with the industry. Thank you.
Hello, Assalamualaikum. My name is Muhammad Fahmi Shafi bin Ahmad Nafizan. Today I will be discussing about situation 2, question 1 and question 2. So, for the question 1 is as the Chief Financial Officer of ABC Corp, there are two independent investment, which is investment number 1 and investment number 2. The question is that determine the number of years needed for each investment to recover their investment cost. In this question, we use payback period formula, which is years of ACF, which is annual cash flow, is less than initial outlay, plus by initial outlay minus by ACF, that is less than initial outlay, divided by the CF after the ACF, that is less than initial outlay, and then we will get the years. So we go through the investment number 1 first. The investment number 1 is for first year is 30, the second year is 50, and the third year is 40. The initial outlay for investment 1 is 50. And then we can get the answer, the payback period, which is years of number of ACF that is less than initial outlay, that is 1. The first year, plus by the initial outlay, which is 50, minus by the ACF, which is less than the initial outlay, which is 30, and then divided by the CF after ACF that is less than initial outlay, which is 50, and then we will get the years. So the answer for investment 1 is 1.4 years. For the investment 2, we use the same formula but different number, which is investment number 2. The first year is 40, second year is 20, and the third year is 80. And then we use the same formula, we will get 2.5 years. And that is the numbers of years needed for each investment to recover their investment cost. The reason we use payback period so that we can know when we can get the investment cost back. Moving on to the question, still in question 1 but number 2. Compute the payback period and net present value, which is NPV, for each investment based on the NPV method. Which project should be adopted and why? Assume that the required rate of return of this investment is 10%. So we use NPV formula. and then we can get the answer, which is the total of CF in bracket PVIFA I comma N minus by initial outlay, and then we will get the answer. So the answer for investment 1 is 48.64 and the investment 2 is 12.99. In this investment, we can accept both because both of these are in positive NPV and they are also independent investment. If the question asks for mutual investment, we can choose the highest NPV. But in this case, it is independent investment, so we can take both of it. The reason we use MPV is so that we can know if the investment we make is in positive or in negative. So if positive, we can accept the investment, but if in negative, we must reject them. And that's it for the question 1. So for the question 2, given the following information for ABC Corp, you are required to prepare a cash budget covering the second quarter 2020. So in order to make the cash budget, we must know the format of the cash budget. And the question asks for the second quarter. So the second quarter of 2020 is April, May, and June. So for the first step, to make it easy, we must follow the columns by columns. The first column is for receipt, and the items are sales, which is April is 240,000, May is 300,000, and June is 270,000. So we move to the question 1, which is 10% of sales is for cash, another 60% is collected in the following month, and the 30% is collected in the second month following sales. So we must calculate the 10%, 60%, and 30% for each month for April, May, and June. And then we will get the credit sales and the first month and the second month. So there are more in this column, which is in the question number 5. The firm will receive interest from its investment totaling 66,000 in May. So we can put the first column in the last item, which is receive interest in May. And then we will get the total cash receipt, which is April is 240,000, May is 366,000, and June is 270,000. So the next column is disbursement. So in the question number 2, the ABC Corp purchases raw materials 1 month before its sales. Amount of raw materials need is 60% of its total sales. The supplier is fully paid 1 month after the month of the purchases. So the credit payment is 60% from 1 month before the sales, which is for April, we take the 60% from March, the May we take from April, and the June we take from the May. And then we will get the answer for the credit payment. Moving on to the next question, which is number 3. The company pays 10,000 per month for renting purpose, 25,000 for salaries and wages, and 20,000 each month for other expenditures. For the depreciation, we did not need to put in the cash budget. So we only put the rent, salaries and wages and other expenses. And then we move to the next question, which is in 2020, the company will make quarterly payment in interest, and total interest for the year is 64,000. Payment will be made at the beginning of each quarter. So April is the first month of the second quarter. So we divide it by 4 and then we will get the 60,000, and then we can get the total cash disbursements for each month, which is 152,000, 199,000, and 235,000 for each representative month. So in the last column, which is the net cash flow, in order to get the net cash flow, we must total cash received minus by total cash disbursement. So for April, we get 88,000. For May, we got 167,000. And for the June, we get 35,000. So the next item is plus beginning cash flow. In the question number 6, the firm's cash balance on 31st March 2020 is 49,000. And then we plus with the net cash flow and we get the ending cash balance of April is 137,000. Less minimum cash balance, which is in the question, a minimum balance of 50,000 is to be maintained at all times, which means we must minus the 50,000 from ending cash balance, and then we will get the surplus for May, which is 122,000. It is surplus, not deficit, because the number we get, the total we get is positive, is not negative. And so for the May is 289,000, and lastly for June we get 324,000. The reason we prepare a cash budget so that we can know the surplus or deficit we can get in the business or in the company in order to continue the company or the project in the future. That's it from situation number 2. Thank you.
My name is Nurul Iman. I'm going to answer situation 3, question 1. Alternative 1, issue 6% bond with 10 years to maturity at the selling price of Rm 950. The flotation cost will be Rm 20 and tax bracket for the company is 35%. First, after reading, we have to determine which formula we have to use. After we choose the right formula, then we have to continue the calculation for question number 1. PV is par value, SP is selling price, FC is flotation cost, YTM is years time maturity, which is 10 years. Done for question alternative 1. Now we go to alternative 2. Alternative 2, issue common share at Rm 45 ringgit. The company has just paid Rm 1.50 per share dividend, and the dividend is expected to drop at a constant rate of 8%. Indefinitely, flotation cost would be 5% of the selling price. First, we have to choose the formula. If D1 is not given, so we will choose the first one. D1 is demand. D1 is annual demand. calculate this, we will get G is 0.08%. Done for question 2. Now we'll go through question 3. Alternative 3. Issue prefer share to no RM100 per but selling price at discount of 9% below its par value. The company has to pay dividend 10% of par value. However, the flotation loss is 3% of the selling price. Calculate, we will get the answer 171.8%. That's all for question 3. Thank you.
Hello everyone, my name is Muhammad Azmizan Shah bin Tizan. I will present the situation for question 1. The question is prepare a pro forma balance sheet for ABC Corp for the years 2020. All the relevant information is given below. The Romans 1 sales for 2020 was RM 10 million and it was expected to increase the 15 million. The company is operating at full capacity. Net income for 2021 was 5 million. Cash dividends for shareholder in 2021 amounted to 2 million. So to find the pro forma, determine the company needs more funds or not. Finds additional fund. Supposedness item will change a certain condition. First, determine the question is full capacity or under capacity. So the question is full capacity. So first determine all sales and new sales. All sales is 10 million and new sales is 15 millions. And let's do the statement for ABC Corp. Statement of pro forma financial position for the 31 December 2020. After we recalculate the asset and liability, after use the formula NRE, we get the 6 million. The new sales is we get at the table. NPM is net income divide with sales, and DPR is cash dividend divide with net income, and the AFN total minus with total current liability, we get the 1,065,000. And last, we find the AFN, which is the total asset minus with total current liability, and we get the we get the 165,000. So that is the AFN. So that's all. Thank you.
Lastly is question 4, question 2, number 1 Roman, which is the question is, for a go trade credit with the credit terms of 2/10 net 30, we need to calculate the EIR. So the formula is discount percent over 100% minus discount percent multiply 360 over final due minus discount period, then multiply with 100%. So the discount percent is 2% over 100% minus 2% multiply with 360 over 30 minus 10, then multiply with 100%. Then we got 2% over 0.98, then multiply 360 over 20, then we multiply again with 100%. So the answer is 0.02 over 0.98 multiply 18 multiply 100 and 100%. So the final answer is 36.03%. Next question is question 2 Roman, which is a line of credit of RM 1 million with 5% commitment fee on the unused fund and a 9% state interest rate. For the commitment fee is 1 million minus 800,000 multiply with 5%, so the answer is 10,000, and for the interest it is 800,000 multiply with 9% multiply 7 over 12, then the answer is 42,000. So the formula for this question is interest plus unused fee over short edge multiply 12 over 7 multiply 100. So interest is 42,000 plus 10,000, which is unused fee, over 800,000, then multiply 12 over 7, then multiply 100. So the final answer is 11.14%. For the question 3 Roman, which is issue commercial paper with a face value of RM 100,000 each at 14 per annum, the issuing cost is RM 2,500 per paper. So for the fee is 800,000 over 100,000 multiply with 2,500. So the answer is 20,000. For the interest is 800,000 multiply with 14% multiply 210 over 360. And then the answer is 65,333.3. Then for the formula is interest over loan minus fee minus interest, and then multiply 360 over n multiply 100. So for the interest is 65,333.3 over 800,000 minus 20,000 minus 65,333.3, then multiply 12 over 7 multiply with 100. So the final answer is 15.67%. For the question for Roman is a loan from NAN Bank at a discounted interest rate of 8% per annum and a 15% compensating balance. The present account balance in the company is RM 100,000. For the formula for interest is loan multiply with percent multiply with n per over 360, and then for the interest is 800,000 multiply with 0.08 multiply 0 over 12, and then the final answer for interest is RM 37,333.3. For the fee formula is loan multiply with percent fee. So the loan is 800,000 multiply with 0.08. Then the final answer for the fee is RM 64,000. Then for the formula for the CB is loan multiply with percent minus balance. So the loan is 800,000 multiply 15%. Then we minus with 100 So the final answer is 20,000. So the final formula is EIR. I plus V over loan minus CB minus I, which is interest, multiply 360 over N multiply 100. So the I is 37,333.3 plus 64,000 over 800,000 minus 20,000 minus 37,333.3 multiply 12 over 7 multiply 100, and the final answer is 23.39%.